Do you shudder when you hear income taxes? Although tax rules can be complex, there are some strategies that may help reduce your tax burden in retirement. But before we dive in, please give the video a like and subscribe for more investing content. The tax tip I want to talk about is income splitting. Income splitting is when a person shifts some of their income to their spouse or common law partner. And it typically works best if that person makes more money than their partner. In fact, the bigger the difference in incomes, the greater potential for tax savings. Let's go through an example. Meet Claudia, who's 63 years old, and Isaiah, who's 60 years old. They're a retired couple that live in Ontario. Claudia has an income of $80,000, which includes $25,000 from an employer pension and $10,000 from CPP. Based on her tax bracket, she pays just under $16,000 in income taxes. Isaiah has an income of $40,000, which includes $3,000 from CPP, but he doesn't have an employer pension. Based on his tax bracket, he pays just over $5,000 in income taxes. Together, they pay over $21,000 in taxes. The first way they can reduce their tax bill is by splitting Claudia's employer pension with Isaiah. Technically, Isaiah doesn't actually receive money from Claudia's pension, but they report some of the pension income as Isaiah's on their joint tax return. Spouses or common law partners can split up to 50% of eligible pension income. So Claudia can assign up to $12,500 of her pension income to Isaiah. While this increases Isaiah's income tax amount to just over $7,800, it lowers Claudia's to around $12,000. Together, they'll now pay around $19,500, giving them a net savings of just over $1,500. Claudia and Isaiah would also receive a pension income tax credit, which anyone may be eligible for after claiming a pension income. Similar to splitting employer pension income, you can also potentially split income from other sources, like life income funds, locked-in retirement income funds, and registered retirement income funds, or RIFs. This could be one reason to convert your RRSP to a RIF before you turn 71 years old, rather than putting it off. To learn more about qualified income sources for splitting, check out the CRA website. Another way to split income is by sharing Canada Pension Plan or CPP benefits between spouses. In this scenario, pension benefits for each spouse are added together and then shared between the two. Eligibility for sharing is based on how much of the CPP contribution period occurred while they were living together. So, if a couple lived together the whole time they contributed to CPP, 100% of their pension is shareable. But if they lived together for only half of the time they contributed to CPP, then only half of their pension may be shared. To qualify, both individuals must be at least 60 years old and an application must be submitted to Service Canada. Let's see how CPP sharing could impact Claudia and Isaiah. As a couple, they received $13,000 from CPP. And since they're high school sweethearts, they've lived together the whole time they contributed to CPP. This means their total CPP benefits for sharing is $13,000. So each of them will receive $6,500 a year from CPP. Now recall that before CPP sharing, they were paying just over $21,400 in taxes. After CPP sharing, their total income tax due is just under $21,000 for a savings of around $300. Another way to split income during retirement is with a spousal RRSP account. In this scenario, the higher income earner makes contributions to a spousal RRSP in their partner's name. However, the contributor claims the tax deduction. Any contributions made must be within the contributor's RRSP contribution limit. This method of income splitting can give couples the flexibility of splitting income until they turn 71. Plus, they can choose the amount of income to split up to the contribution limits. Let's see how this could help Claudia and Isaiah. Say Claudia contributes $5,000 to a spousal RRSP in Isaiah's name. This reduces her taxable income to $75,000, making her income tax bill just over $14,000 for a tax savings of just under $1,500. It's important to note that when Isaiah withdraws money out of his spousal RRSP, he will have to pay income tax on the amount he withdraws. Ideally, his income at that time will be significantly less than Claudia's current income of $80,000, so they can maximize their tax savings. Additionally, the spousal strategy can help balance the size of both Claudia and Isaiah's RRSP accounts. This could prevent Claudia from having a large RIF account that she's forced to make taxable withdrawals from. Now that you've seen how each tax strategy works, the last one to know is using all three of these at the same time. In fact, if Claudia and Isaiah employ all of these at once, they could save over $3,200 on taxes this year. That wraps up this lesson on income splitting. I hope that the simplified example of Claudia and Isaiah gets you thinking about your situation. If you found this video helpful, please like and subscribe for more investing content. Join me in the next lesson to discuss another potentially uncomfortable topic, estate planning.
Have more questions? Check out the links to the right and in the description below.